Don't underestimate the Fed. The markets might be underestimating inflation and underestimating the heights and duration the Fed is willing to go to fight it. One analyst saying that we could be in for a crash landing as reality hits. And joining us now is David Neuhauser, Livermore Partners CIO. And David, thank you for joining us here today. Got to talk about the economy and your prediction for it, because you don't think that we're going to get that soft landing here. And I've been looking at the global credit impulses contract, in fact, crash last year, pointing to something happening maybe March, April of this year. Just wondering if that's aligning with what you're looking at. What's the potential downside scenario in terms of the economy and markets?
Yeah, so that's an excellent question. So I think, Livermore, focused last year, actually going back over about a year and a half ago, is when we became extremely bearish in terms of the market dynamics, and also in terms of technology, because of course they have the highest growth stories, they have the highest multiples, and any changes to the Fed funds rate and the discount rate will ultimately affect their earnings in a big way. I think a lot of investors were caught flat-footed because they've seen from the past decade that this sector was like the best sector to own, and they weren't prepared for what occurred. So we were upfront on that with our hedge fund, and it served us really well as we profited on the short side. Today, like you described, I look at 2023, trying to determine what is sort of the path of the economy, what is the path of the market, and I think a lot of that will still be dictated by the Federal Reserve as far as how hard they move on interest rates. So that'll determine, of course, ultimately, I think, where things shake out. But our view is that the terminal rate for interest rates is going to be around 5%. It's going to stay there. It also has the potential to even climb to 6%. I think the market is ill-prepared for anything like that, even today.
Where do you think rates are at when the effects or the early effects of what could lead to that crash landing is starting to brew or starting to take form or take shape?
Well, you're seeing some of that today. Mm-hmm. So, for example, we were, our fund was short a lot of these tech names because, again, they're the highest values. A lot of them fell, 50, 60, 70%. We were short things like Tesla and Arc Innovation and Coinbase and all these things that were trading at kind of crazy multiples. And we're pretty public on it, too. So you could actually see that if you're able to search that. But today, looking forward, a lot of those multiples have contracted. So even though I'm still pretty bearish on that sector, I think what it'll really affect is, and you're starting to see it today, is some of the subprime and some of the credit areas. So you're starting to see credit quality weaken. You saw that with even the banks this week with some of the news out, Capital One especially, and they're starting to see these layoffs. That'll bleed into the economy as far as a further downside and weakness in the economy. And I think ultimately that'll affect earnings. Ultimately, that affects the market.
I want to talk about gold here and then relate it back to a prior comment you said. On the Wi-Fi Interactive, I'm just going to show a 5-year chart of gold, and you can see we've been kind of treading water going sideways since early 2020. Had a little bit of a fake breakdown here. But you said something really interesting a couple minutes ago. You said potential for 6% terminal rate with the Federal Reserve. Market participants not expecting that. I got to think that real yields are just going to shoot through the roof if that happens. And what does that do for the price of gold in that scenario? How does it end up eventually?
Yeah, so again, very good question. I think historically, when you look at gold, you see that gold in a lot of ways will have issues with the de-risking of it. And I think in this regard, gold will outperform because the 10-year rate is still substantially lower. And ultimately, that'll be the focus.
David Neuhauser, Livermore Partners CIO. Thank you so much, Sheriff, for joining us and taking the time here this morning. Appreciate it.